Okay, let's unpack this. If you were brave enough to look at your portfolio on uh, Tuesday, January 21st, 2026,
Mm.
you probably felt that specific kind of knot in your stomach. You know the one?
I do?
We are talking about over $1 billion
Billion.
fleeing U.S. crypto ETFs in a single brutal day. I mean, it was just red screens everywhere, absolute panic in the group chats.
It was definitely a sea of red. And when you see giants like, BlackRock and Fidelity posting those kinds of outflow numbers, it really shakes the room. It feels heavy.
It feels like the sky is falling.
Yeah.
And looking at the surface, you'd be forgiven for thinking, okay, party's over, lights are on, time to go home.
Right.
But here's where it gets really interesting. We have data showing that while everyone was panic selling, the smart money, the whales, were doing the exact opposite.
They were buying it.
They were buying, and not just like nibbling, they were feasting.
That is the massive paradox we need to explore today. It's such a classic divergence. On one side, you have retail investors just fleeing because the macroeconomic headlines are, frankly, terrifying.
Yeah.
On the other side, you have these large-scale holders just absorbing all that sell pressure. But, and this is key, that market drama is only one thread of the story we have for you today.
Right. We are on a mission to connect three very different but totally crucial threads to really understand the state of the world in January 2026. So thread one is that market panic and the whale response. Thread two is what the financial advisors are doing behind the scenes. And we have this fascinating survey that exposes a pretty hilarious do as I say, not as I do dynamic there.
And thread three, this is the one that honestly kept me up last night. It is a new research paper called Speaking to Silicon.
Okay.
It has nothing to do with finance charts and everything to do with physics. It claims we can save over 90% of Bitcoin mining energy by treating computer chips like neural networks.
Okay, I have to be honest. When I saw 90% energy savings in the outline, my scam alarm went off.
I get it.
It sounds like vaporware. It sounds like science fiction.
I thought the exact same thing until I read the proofs. The math is apparently verified.
Well, we're going to grill you on that later because that is a bold claim.
Fair enough.
So the promise for today, by the end of this deep dive, you'll understand why a 7% price drop might actually be a bear trap and how the fundamental physics of mining is about to change the economics of the entire network.
Let's do it.
But let's start with the crime scene. What exactly happened on January 21st?
So the headline number is staggering. U.S.-listed Bitcoin and Ethereum ETFs saw over $1 billion in outflows.
Wow.
To be specific, BlackRock's iShares Bitcoin Trust lost about $356 million, and Fidelity lost another $287 million. It was the biggest one-day redemption event since November 2025.
That is a lot of money leaving the table. So the obvious question, did Bitcoin break? Did the network halt?
Nope. The network hummed along perfectly. The world got shaky. This was a classic macroeconomic shock. You have to look at the geopolitical context. President Trump made some remarks at Davos about new tariffs on Europe and, maybe more surprisingly, mentioned potential military action over Greenland.
Right, the Greenland situation. That kind of came out of left field.
It did. And markets hate uncertainty, but they hate the threat of conflict even more. That created an immediate risk-off environment.
Right.
When institutional investors get scared of global instability, they sell the assets they see as risky to move into cash or bonds. And for them, crypto is still high on that risky list.
It's funny, though. The narrative used to be that Bitcoin is a hedge against chaos. But when actual chaos hits, the first thing people do is sell it.
In the short term, yeah. It's a liquidity crunch. When people are scared, they sell what's liquid. But this is where that divergence comes in.
Right.
While retail traders, and we're talking about wallets holding less than 0.1 Bitcoin, were panic selling, the whales didn't blink.
Define whales for us here. Are we talking about someone with like 2 or 3 coins?
No. We are talking about serious weight. Wallets holding between 10 and 10,000 Bitcoin.
Okay, that's big.
In the last 5 days, while the ETFs were bleeding, these entities purchased over 34,000 Bitcoin.
34,000. That's a lot of buying power.
It's massive, and it represents a transfer of wealth from, impatient hands to patient hands. The whales look at a geopolitical scare and see a discount. Retail looks at it and sees the end of the world. And there is another data point that backs this up. We saw a supply shock event. In a single 4-hour window this week, 19,700 Bitcoin moved off exchanges.
Moving off exchanges usually means I'm not planning to sell this anytime soon.
Okay.
It's going into cold storage,
Into the vault.
into the vault.
Precisely. Exchange supply is down to roughly 1.18 million Bitcoin. That is incredibly low historically. So you have this liquidity crunch forming. The price drops because of paper selling in the ETF market, but the physical underlying asset is disappearing.
There was one other weird thing in the market data I wanted to ask you about. Bitcoin and Ethereum were bleeding out, but smaller funds, Solana and XRP, actually saw inflows. What is that about? Is that just noise?
I don't think it's noise. I think that's the altcoin anomaly. While the majors lost $1 billion, Solana ETFs took in about $3 million, and XRP took in over $7 million. It suggests institutions are starting to decouple these assets. They aren't just buying crypto as a single basket anymore.
They're picking winners.
Or at least picking specific utilities. They're looking for, specific thematic exposure, maybe payments for XRP, speed for Solana rather than just digital gold. It shows a real maturation in the market.
Okay, so investors are getting pickier, and the big players are buying the dip. Speaking of the people managing the money, let's pivot to our second thread. The Bitwise Verify 2026 Benchmark Survey. This is the annual check-in with the financial advisors, the suits.
Yeah.
What are they thinking?
They are thinking it is time to get in, but they are nervous. The headline stat here is that 32% of advisors now allocate to crypto in client accounts.
32%.
That is an all-time high, up from 22% just a year ago.
That is a huge jump in 1 year, almost a 50% increase in adoption.
It is, but here's the number that made me laugh out loud. 56% of advisors own crypto personally.
Wait, hang on. So more than half of them own it themselves?
Yeah.
In their personal stashes?
Yeah.
But only a third put it in client accounts.
Exactly.
That is the definition of do as I say, not as I do. Why the gap?
It's the professional barrier. They believe in the asset class enough to put their own, mortgage payments at risk, but they face hurdles doing it for clients.
Sure.
And the survey tells us exactly what the biggest hurdle is.
Let me guess. Is it still regulation? Are they afraid the SEC is going to kick down the door?
Surprisingly, no. That used to be number one. Now, the number one reason they hesitate is volatility. 57% cited it as the main barrier. Well, think about it from their perspective. You're an advisor. You put 5% of your client's retirement into Bitcoin. Then Tuesday happens.
Right.
Trump says something about Greenland, and the portfolio drops. Your phone starts ringing. Your client is screaming at you.
Yeah, nobody wants that phone call. Why did my retirement account just lose 10%?
Exactly. Regulation is still a concern, but it's secondary now because the landscape has shifted. We had the Genius Act pass in November 2025.
Right.
The first major U.S. crypto law. It legitimized stablecoins. So the is this legal question is mostly answered. Now it's the will this make me look like an idiot question.
So how do they solve the volatility problem? You can't just ask Bitcoin to, calm down.
No, but you can insure against it. And this is where we connect the dots to a recent move by NASDAQ. Just this week, NASDAQ removed the 25,000 contract limit on Bitcoin and Ethereum ETF options.
Options trading. Okay,
Yeah.
For the listener who hears options and thinks gambling, break that down. Why does this help the advisor sleep at night?
Right. For a retail gambler, options are a way to bet big with small money. But for an institutional advisor, options are how you remove risk. They let you hedge. If you are terrified of a 20% drop, you can buy a put option, which basically acts as an insurance policy. If the price crashes, the option pays out and it offsets the loss.
So the portfolio stays flat even if the market tanks.
Correct. Lifting that cap allows big institutions to hedge properly at scale. It directly addresses that number one fear in the survey. It gives them the tool to manage the volatility they are so afraid of.
So we have whales buying the panic, advisors wanting to get in but fearing volatility, and the market structure changing to let them manage that volatility.
Yeah.
That sets the stage for a pretty bullish long-term view.
Yeah.
But there's always that one lingering argument, the elephant in the room.
The energy argument. It boils the oceans.
Right. And this brings us to our third thread. This is the deep dive part I've been waiting for, and frankly, the part I'm most skeptical about. We have a research paper titled Speaking to Silicon. It was published this month, January 2026. And you're telling me this paper claimed to reduce energy usage by 92%.
92.19% to be exact.
Okay, walk me through this. Because we've heard green mining promises for a decade. Usually it's just, oh, we'll use wind power, but this sounds different. This is about the chips themselves.
It is fundamental physics. The paper argues that we have been treating Bitcoin mining chips ASICs completely wrong.
How so?
We treat them like dumb calculators. We feed them a number, they crunch it, and they tell us if it won the lottery.
And usually they lose.
Right. 99.99% of the time, the computation fails to mine a block. It's just wasted energy. But this paper says these chips are not passive calculators. They are conversational partners. They have thermodynamic signatures.
Conversational partners. You're losing me. Are we talking to the chip?
In a way, yes. The chip reacts physically to the data you feed it. Think about it like this. The researchers found that by measuring the timing jitter and the thermal variations.
You mean literally how the chip heats up and stutters?
Exactly. Just by watching that in the first 5 rounds of the hashing process, they can predict the future.
Wait. There are 64 rounds in a hash, right?
Correct.
So you're saying they only run the first 5, look at how the chip sweats,
Yeah.
and they know if it's going to fail.
That is exactly it. They call it the thermodynamic probability filter, or TPF.
I need an analogy. Help me visualize this.
Okay. Use the analogy from the paper. Imagine you are packing a backpack for a trip. You have a pile of giant, jagged rocks and a pile of fine sand.
Okay.
And you need to fit it all in. If you grab the giant rocks first, let's call them the bad bits, and you try to shove them in, and they immediately stick out the top of the bag.
Right.
Do you keep trying to pour the sand in? Do you zip it up and hope for the best?
No, it's already full. It's failed. I dump it out and start over.
Exactly. But current Bitcoin miners are dumb.
Yep.
They see the rocks sticking out, but they spend the electricity pouring the sand in anyway, zipping it up and checking the result, only to say, oh, it didn't fit.
So they are running the car all the way off the cliff every single time.
Yes. The TPF spots the giant rocks in the first few microseconds based on that thermal jitter. If it sees the rocks, it aborts the calculation immediately, cuts the power.
And that's where the 92% savings come from.
Yeah.
Just not finishing doomed calculations.
That's it. You are only spending energy on the hashes that actually have a statistical chance of winning.
That is actually incredibly clever. But you mentioned something else in the outline, reservoir computing. That sounds like AI stuff. How does that fit in?
This is the mind-bending part. By measuring that jitter, they are effectively treating the silicon chip as a neural network.
The physical one.
A physical neural network. The chip isn't just a logic gate. It's a chaotic system that reacts to input. They are using the chaotic physical reaction of the silicon as a computational resource.
So the flaw in the chip, the heat, the jitter, becomes the feature.
Precisely. It turns a brute force industry into a listening industry. They listen to the noise of the chip.
Okay, I'm still stuck on the vaporware possibility. It sounds great in a PDF. But does the math actually work? Or is this just theoretical physics?
That is what makes this paper the definitive edition. They didn't just write equations. They proved them using Lean-4.
Lean-4, what's that?
It's a programming language for logic verification. It's like a spell checker for advanced mathematics.
Okay.
Usually in research, you have steps where you say, we assume this is true, and you move on. In Lean-4, those are called sorries. Like, sorry, I can't prove this yet.
It's a trust me, bro.
Exactly. This paper has 0 sorries.
0?
0. Think of it like building a bridge. Instead of just drawing a blueprint and hoping it holds, every single bolt, every beam was simulated and verified by a computer that creates a mathematical proof that the bridge cannot fall down.
Okay.
That is what they did for this mining algorithm.
Okay, that carries a lot more weight than a marketing brochure.
Yeah.
So TPF saves the energy, but there was a second acronym, VBM, the pizza eater.
Right, the virtual block manager. This solves a different problem. Latency.
Which is just waiting around.
Yeah. When a miner finds a block, there is a tiny delay before the next job arrives from the mining pool. It's milliseconds, but in that time, the miner sits idle, consuming power but doing nothing useful. Pure waste.
Right.
The VBM uses local prefetching. And here's the pizza eater analogy. Imagine you are at a pizza contest. You finish a pizza. You have to wait for the waiter to bring the next one. You stop chewing.
You're wasting time. I hate waiting for pizza.
The VBM is like having a butler who orders your second pizza before you finish the first one. He times it perfectly so that the exact millisecond you swallow the last bite, the next pepperoni slice slides in front of you. You never stop chewing.
So I get fat faster.
In this case, your wallet gets fat faster. They claim this increases the effective hash rate by 25% without adding a single piece of new hardware.
So let's synthesize this, because if this is real, it's huge. You have 92% energy savings from the TPF, plus a 25% boost in effectiveness from the pizza eater.
The environmental argument.
The environmental argument against Bitcoin essentially evaporates, doesn't it?
It does, and connect that back to our advisor survey.
Yep.
Remember, apart from volatility, the other big reason institutions hesitate is ESG, environmental, social, and governance mandates. We can't buy Bitcoin because it's dirty.
Right.
If this speaking to silicon tech gets adopted, Bitcoin becomes one of the most energy-efficient computing networks in the world relative to its security. It completely removes the moral objection for the BlackRocks and the pension funds.
That clears the runway. So we have the tech solving the energy problem, the options market solving the volatility problem, and the whales buying the dip. Let's look at the outlook.
Yeah.
Despite the red screens this week, what are the advisors expecting for the rest of 2026?
They remain incredibly bullish. 65% of advisors think Bitcoin will be higher in a year. 62% say the same for Ethereum.
Okay.
And interestingly, a big chunk, 22%, are now interested in it specifically as a debasement hedge.
Which means protection against the dollar losing value.
Yes. Digital gold. And this brings us to a critical price context that people are missing because of the panic. Right now, Bitcoin is trading near, what, $90,000 to $91,000?
Right.
It is lagging
Lagging behind what?
gold and the S&P 500. Both traditional gold and the stock market are hitting all-time highs right now. Bitcoin is usually highly correlated with them. When liquidity is high, everything goes up. But this week, because of that specific Greenland Trump panic, Bitcoin dropped while the others soared.
So we have a divergence. The rubber band is stretching.
Exactly. The rubber band has stretched too far. When you combine that with the supply shock, remember those 19,700 BTC pulled off exchanges? And the whale accumulation, the conditions are perfect for a catch-up trade.
It really does feel like a coiled spring. You have the retail panic selling, creating a discount, the whales happily buying that discount, the regulatory clarity coming from the Genius Act, and now this potential technological revolution in mining efficiency.
It is the perfect storm for a long-term bull case, just masked by a short-term bearish headline.
So what does this all mean for you listening right now? It means that when you see red on the screen, you have to look deeper. You have to ask who is buying when you are selling.
Yeah.
It means that the smart money isn't scared of the volatility. They're finding ways like options to manage it.
And it means that the technology underpinning this whole ecosystem is evolving faster than most people realize. We aren't just hashing numbers anymore. We are beginning to use the physics of silicon in ways we didn't think were possible.
Which brings us to our final thought for the day. And this one comes directly from the implications of that Speaking to Silicon paper. It's a bit of a mind bender.
This is fascinating. The paper mentions that every ASIC chip has a unique thermodynamic fingerprint because of tiny microscopic manufacturing variations.
Okay.
No two chips heat up exactly the same way. They call it a PUF, or a physical unclonable function.
So like a fingerprint or an iris scan, but for a computer chip.
Exactly. So if your mining rig has a unique, almost biological style fingerprint, consider this. Could your miner eventually become your digital ID? Could that hot humming box in your basement be the most secure login key for the internet that has ever existed? An ID that you can't fake, because you can't fake the physics of how a specific piece of silicon releases heat.
That is wild.
Yeah.
It turns the miner from just a revenue generator into an identity anchor.
It's a distinct possibility.
Well, look at the timing jitter in your own life. Sometimes the noise holds the signal.
Thanks for listening to this deep dive. We'll catch you on the next one.